What if everything you learned about World War I missed the most important part of the story? Most people think it started when an Austrian archduke got shot in Sarajevo, but that's like saying the Titanic sank because it hit ice. Sure, that's what happened on the surface, but what if the real cause was something completely different? A financial crisis that had already bankrupted Europe's great powers decades before anyone fired a shot. What if I told you that Europe's great powers had already bankrupted themselves decades before the first shot was fired? What if the assassination was just the excuse they needed to solve a financial crisis that threatened to destroy their empires? Let me show you how mounting debts turned political rivalries into financial necessities, and how the greatest military conflict in human history was actually the world's most expensive debt consolidation program. The story begins in the 1850s when European powers discovered something that would change the world forever. You could borrow money to build an empire faster than you could earn it through conquest. Britain led the charge using massive loans to expand railways across India, build naval bases across 6 continents, and maintain the largest military force the world had ever seen. The system worked brilliantly as long as the empire kept growing and generating new revenue streams. But here's where the math gets dangerous. By 1914, Britain's national debt had ballooned to £650 million, an astronomical sum that required careful management of interest payments and constant refinancing. France, Germany, and Russia followed the same playbook, each borrowing heavily to fund their own imperial ambitions. They thought they were playing a game of territorial expansion. They were actually playing a game of compound interest. Think about your own mortgage for a moment. You probably calculated your monthly payments carefully, made sure you could handle the interest rate, and maybe even got pre-approved before house hunting. Now imagine if your neighbor was also buying houses and your other neighbor was buying even bigger houses, and suddenly you felt pressure to buy more houses just to keep up. That's essentially what happened to Europe's great powers, except instead of houses, they were buying battleships, armies, and entire continents. Germany provides the most dramatic example of this imperial debt spiral. Under Kaiser Wilhelm, German borrowing exploded as the nation tried to challenge British naval supremacy, while simultaneously building railways across Africa and establishing colonies in the Pacific. The German government convinced itself that each new territorial acquisition would pay for itself through resource extraction and trade revenues. Sound familiar? It's the same logic that fueled our housing bubble in 2008, the belief that rising asset values would always cover rising debt payments. But the real shock comes when you look at the Ottoman Empire, which serves as a preview of what happens when imperial debt gets out of control. In 1875, the Ottoman government declared bankruptcy with debts totaling £200 million. Here's the kicker. Their annual debt payments exceeded half of their national revenue. European creditors didn't just write off the loss. They established the Ottoman Public Debt Administration, which gave foreign bondholders direct control over Turkish tax collection and government spending. Think about that for a second. A sovereign nation controlling territory across 3 continents essentially became a subsidiary of European banks. Ottoman sultans could still wear their ceremonial robes and hold their fancy titles, but real financial decisions got made in London, Paris, and Berlin. This wasn't just debt restructuring. This was the template for modern financial colonialism. The Declaration of London in 1914 made this dangerous game official, formally recognizing credit as an essential element of the Anglo-French-Russian alliance. Military partnerships were now explicitly tied to financial partnerships. When you signed up as an ally, you weren't just agreeing to fight together. You were agreeing to borrow together, guaranteeing each other's debts and sharing the financial risks of imperial competition. By 1914, every major European power was trapped in the same impossible situation. They owed massive debts that required constant territorial expansion to service. But territorial expansion required even more borrowing, which created even larger debts. The system had become mathematically unstable. Something had to give. Either these empires would find a way to dramatically increase their revenues, or they would face financial collapse. War, it turned out, offered both a solution and an excuse. Military victory would mean access to enemy territories and resources, potentially solving the revenue problem. Military necessity would justify levels of government borrowing that would be politically impossible during peacetime. And most importantly, War would allow governments to restructure their entire financial relationships with both their own citizens and their international creditors. Those European emperors weren't expanding empires. They were expanding liabilities that would eventually consume everything they claimed to protect. Here's where the story gets really interesting, because by 1916, something unprecedented was happening in global finance. Britain wasn't just funding its own war, it was funding most of the empire's expenses, all of Italy's war costs, and two-thirds of what France and Russia were spending on their military operations. Think about that for a moment. One country was essentially paying for a world war involving dozens of nations. How does that even work financially? The answer lies in a web of international banking relationships that most people have never heard about, but which determine the fate of millions. When you understand how these financial arrangements actually worked, the entire war starts to look less like a political conflict and more like a massive debt collection operation with armies instead of repo men. Let's start with a question that should grab our attention. Why was J.P. Morgan Jr., an American banker, organizing military supply contracts for European armies 2 years before America even entered the war? In 1915, Morgan put together a syndicate of 2,200 American banks to float a $500 million loan to the Allied powers. But here's the kicker. This wasn't just a loan. Every single British munitions purchase had to go through Morgan firms, giving American bankers direct control over European military procurement. Pop quiz. When a foreign bank controls your military supply chain, are you still a sovereign nation, or have you become something else entirely? Britain, the empire that ruled a quarter of the world's landmass, had essentially outsourced its war finance to Wall Street. The lion was borrowing money from the eagle to buy bullets. But the really wild part is what happened to interest rates during this period. As European governments borrowed more and more money to fund their military operations, the cost of borrowing kept climbing. Higher interest rates meant that territorial expansion wasn't just politically desirable, it was mathematically necessary. You needed new revenue streams just to service your existing debt, let alone fund new military campaigns. France and Russia found themselves in an especially dangerous position. Their gold reserves, which had been dwarfing those of the Bank of England, according to financial records from the period, became crucial leverage in alliance negotiations. When you're negotiating military alliances, you're not just promising to fight together. You're promising to share the financial burden of keeping each other's governments solvent. Here's where it gets almost surreal. Germany's Reichsbank was providing short-term credit to the government while war loans consolidated long-term debt, creating what financial historians now recognize as an early version of debt monetization. The German government was essentially printing money to pay interest on money it had already borrowed to fund military operations that were supposed to generate enough plunder to pay back the original loans. Does this sound familiar? It's the same cycle that led to our 2008 financial crisis, except instead of mortgage-backed securities, European powers were betting on victory-backed securities. Each new military campaign was supposed to pay for itself through territorial conquest, resource extraction, and reparation payments from defeated enemies. The Bank of England, Rothschilds, Beerings, Morgans, Kleinvorts, and Schroers, London's 5 great merchant banks, dominated international investment ventures and had enormous financial stakes in the outcome of European conflicts. These weren't neutral observers providing banking services. They were active participants whose bond portfolios depended on specific military outcomes. Let me put this in perspective with a modern example. Imagine if Goldman Sachs, J.P. Morgan Chase, and Bank of America had each loaned billions of dollars to different sides in a regional conflict with the loan terms depending on who won the war. Now imagine that these banks also controlled the weapons suppliers for each side. Do you think those banks would remain neutral, or would they have strong incentives to influence the outcome? That's exactly what happened in Europe between 1914 and 1918. International lending had created mutual dependencies, where creditor nations had vested interests in their debtors' military success. When Britain loaned money to France and Russia, British banks weren't just hoping for loan repayment, they were betting on Allied victory. When German banks financed Austrian military operations, they were making the same kind of bet on Central Powers' success. The result was a financial system where military defeat meant not just political humiliation, but complete economic collapse. Losing the war meant defaulting on international loans, losing access to global credit markets, and facing the kind of foreign financial control that had already happened to the Ottoman Empire. By 1916, credit restrictions and rising interest rates had made territorial expansion the only viable strategy for avoiding bankruptcy. European powers weren't fighting for glory or nationalism or even strategic advantage. They were fighting to avoid the financial equivalent of foreclosure. The war had become a massive game of musical chairs where whoever stopped fighting first would face complete economic devastation. This is why the conflict escalated so quickly and became so brutally total. It wasn't enough to win a few battles or negotiate a favorable peace treaty. Each side needed complete victory to generate enough plunder and reparations to pay back their international creditors.